Tony Pasquariello, Goldman Sachs' head of hedge fund client coverage. He joins us back at Post 9. It's good to see you. Welcome back.
Hey, Scott.
So you put out a note, usually Saturday mornings, which a lot of us get and everybody reads, right? Last week, the headline on your note was the path of least resistance was likely higher. Ugh. I come here on Friday and I'm like, uh-oh, what is he going to write now?
Sometimes you get the bear, and sometimes the bear gets you.
Yeah.
The path of least resistance was lower, not higher. I'd say a few things, I think, in terms of trying to understand what's playing through in the market. One is, I think investors are holding their breath around a very fragile geopolitical backdrop. I'd use the same word choice as it relates to the bond market. I think stock operators are holding their breath as it relates to interest rates. And then the third piece is, and this is where I think we were surprised about the setup, mega cap tech earnings, clearly a net negative for the market. So we can impact any one of those.
Has the game changed as a result of that?
I don't think so. I mean, I think if we sift through earnings quality itself, the quarter was fine. It's true for the companies who were in question this week. I think it's more broadly true of the index. So the percentage of companies beating final estimates was higher than normal. I think the challenge was twofold. One is, I think it's hard to disassociate that local price action from the broader risk-off narrative. I think sometimes the acronym, the PAC of those stocks, moves as a group in a risk-off or a risk-on context. I think the other piece is, if you didn't upwardly revise 2024 guidance, the market punished you. On net for S&P and NASDAQ, that estimate hasn't come down. It simply hasn't gone up. And again, I think the bar was higher for those stocks than we realized.
One of the telltale signs of a dicey market is when earnings come in good and stocks still go down. How problematic is that?
Well, I think that tells you a good bit about flow of funds and positioning. And what I'd say on that front is we've had a very busy couple of weeks in our franchise. I think the systematic trading community is trading around a record short. I think the fundamental community have been in sell mode. So if you look at our prime brokerage data, length held by clients is at a 3-year low. And on top of that, and this is where things will improve, you've had a corporate community who have been in back blackout mode that is starting to turn in the other direction as companies report. So I do think the technicals get better, but they've been very difficult over the past couple of weeks.
If I shouldn't give up the ship, which is the sort of the way we teased you, what's the most important or powerful catalyst for reasons that we shouldn't to still think we could have a move between now and the end of the year?
So if I were to sketch out a bullish call for November and December, I think it's three things. I think it's one is growth remains strong, but not too strong. So here's what I find so interesting about the world we live in. If you and I were sitting here in August, the consensus estimate for Q3 GDP was 50 basis points. We know from yesterday Q3 GDP was not 50 basis points. It was 10 times that. It was 4.9%.
Right.
What happened along that path? Well, S&P sold off 3 handles. Why? Because the long bond backed up 75 basis points. And so that, again, that cat and mouse game, I'll use that word choice again, has been very difficult for the stock market. So I think one is, if growth actually slows down a little bit, which is our expectation, in a way I think that will take down the temperature on the rate market and the equity market will breathe more easily.
So you're more apt to say that yields are in the peaking process.
I would hope so. I mean, the front end's been very steady, so that's been helpful. The back end is where people have been nervous. That's been the most disanchored. An open debate about how we're going to soak up all this duration next year. But again, I think we go from a 5% run rate in GDP to a 1 or a 2% run rate for GDP. I actually think that's a more friendly temperature for the market. And then the second piece alongside earnings would be flow of funds. And again, I think the market is probably sold out. I think positioning sentiment is about as negative as it could be. And I do think the corporate bid is usually very forceful in November and December. I don't want to make too much of market seasonals. You seem I feel kind of funny talking about it in this context, but typically November and December comprises the best 2 months of the year.
Does Powell give us some kind of Halloween surprise next week that we need to be cognizant of? What are your thoughts around that meeting?
We think they're done. The market thinks they're done.
Done fully.
Done with the cycle. I think the rhetoric from the committee suggests they want to be done. Now, you've pointed this out. I think Powell has been able to sit back a little bit and let the market do the work for him. So if you look at our financial conditions index since the summer, the backup has been equivalent to essentially 75 basis points of rate hikes. That might be appropriate given how strong the economy's been. A lot is going to happen between the November and the December FOMC, certainly as it relates to the geopolitical backdrop. We have a refunding announcement. We could have a government shutdown, although that is not our view. My guess is he plays it pretty close to the vest and, again, lets the market do some of the heavy lifting for him for now.